Hey everyone, we need to talk about what just happened to precious metals this weekend and what's continuing right now as I'm recording this. Gold just dropped $200 today. That's 46.89 per ounce, down 4.1% in a single session. Silver fell 444, sitting at $80.71. That's over 5% gone today alone. But here's the part that should terrify you. Silver is down 41% from its record high just 3 weeks ago. If you bought silver at 121 in mid-January, you've lost nearly half your position. On a $10,000 silver investment at the peak, you're sitting on a $5,900 loss right now. Gold's not much better. From 5,100 down to 46.89. That's an 8% haircut. But here's what mainstream media isn't telling you. This wasn't a normal market correction. This was a structural break caused by 3 specific events that collided between Friday and today. And what happens next depends entirely on how you understand what just happened. Something bigger is happening beneath the surface. Here are the 3 things that converge this weekend. First, on Friday, January 30th, President Trump nominated Kevin Warsh to be the next chairman of the Federal Reserve. Kevin Warsh is known as a hawk. He supports tight monetary policy, higher interest rates, and a strong dollar. The market interpreted this nomination as the end of the currency debasement trade. Within hours of that announcement, gold crashed from above 4,900 to around 4,400. That's 10% in one day. Silver got obliterated, down 30% at one point, falling from over $100 to lows near 72. Why? For months, the rally was driven by one narrative. Central banks would keep printing money, the dollar would weaken, and hard assets would protect you. Warsh's nomination killed that narrative instantly. Second, the CME Group raised margin requirements, twice, in 3 days. Let me break this down. When you trade futures, you post margin, collateral, usually a percentage of the total. For weeks, silver margins were at 11%. Gold was at 6%. On Friday, CME raised those requirements. Gold went from 6% to 8%. Silver jumped from 11 to 15%. Then they announced a second increase effective after today's close. Here's what that does. If you're holding leveraged long positions, you suddenly need more collateral. If you don't have the cash, you're forced to sell. That selling creates more downward pressure. Prices drop. More margin calls. More forced selling. It's a cascade. According to Bloomberg, silver margins hit 15% for normal accounts, 16.5% for high-risk accounts. That's a 50% increase in margin requirements in 72 hours. Third, we hit month-end and option expiry right after a 71% silver rally. Silver went from the mid-40s in December to 121 in January. Gold climbed 30%. When you get parabolic moves like that, you get massive speculation. Month-end means funds rebalance and take profits. Option expiry means underwater traders must close positions. Combine that normal profit-taking with the Warsh announcement and margin hikes, and you don't get a correction. You get a liquidation event. Those 3 factors hit simultaneously. The result was the worst 2-day precious metals decline since 1980. Here's the part Bloomberg is ignoring. This crash reveals exactly how modern markets work, and some of the smartest money on Wall Street is calling this a buying opportunity. I analyzed the chart this morning. Silver opened around 76, touched 72, then recovered above 80. That's a 10% intraday swing. We shattered through support at $85. The next level I'm watching is 70. That would be another 13% drop from here. For gold, the key zone is 4,400 to 4,600. We're in the middle at 46.89. If this holds through the week, we could see a technical bounce. When gold drops more than 8% in 2 days and stabilizes, it historically rallies 10 to 15% over the next month. The relative strength index shows extreme oversold conditions. Both metals are deep below 30 on RSI. That typically leads to a short-term bounce within days. Trading volume on Friday was the highest in over a year. This wasn't panic, this was institutions taking real action. This reminds me of March 2008, right before the financial crisis, when gold crashed from 1,030 to 700. Leverage unwound, margin calls cascaded. Gold recovered within 18 months and hit 1,900 by 2011. Now let's talk fundamentals. Global silver demand hit 1.3 billion ounces in 2025. That's up 7% year over year, driven by solar installations, electric vehicles, and defense systems. These aren't speculative, they're locked-in industrial uses. Supply? 870 million ounces from mines. Demand was 1.3 billion. That's a structural deficit of 430 million ounces per year. Here's the critical part. 70% of silver comes as a byproduct of copper and zinc mining. When those operations slow, which is happening now, silver supply gets squeezed. Let me put this in perspective. Industrial demand is locked in. Solar panels installed this year consume silver for 30 years. EVs on the road aren't going back to combustion engines. Defense contracts are multi-year. None of that demand disappeared because Kevin Warsh got nominated. Professional money moved before the crowd noticed. Central bank gold purchases hit 1,050 tons in 2025. China's central bank added gold for 14 straight months through December. Turkey added for 19 consecutive months. Here's what today's move revealed. According to Bloomberg, gold ETF outflows were 30 tons this week, but during the rally from November to January, fund holdings grew by 220 tons. They've sold 30 on the way down. Net position, still long 190 tons. The big money isn't panicking. Retail investors are selling physical metal, trying to minimize losses. Institutions are holding or quietly accumulating. When retail panics and institutions accumulate, that's historically been a major bottom signal. I want to share something critical. Gregory Shearer at JP Morgan told Reuters just 8 hours ago that despite the crash, JP Morgan expects gold to reach $6,300 per ounce by the end of 2026. They're forecasting 800 tons of central bank purchases this year. Gold just crashed to $46.89. JP Morgan says it goes to $6,300 within 10 months. That's a 34% gain from here. Mining companies, the ones pulling this metal out of the ground, they're locking in sales at $4,800 for gold, $90 for silver. They're not panicking. They see the real supply and demand picture. History is repeating itself. In January 1980, silver did something remarkably similar. It rallied from $11 to $50 in 4 months. Then COMEX changed margin rules. Silver crashed from 50 to 11 in 8 weeks. That's a 78% drop. Sound familiar? We just saw 30 to 40% in days. But here's the key difference. In 1980, Paul Volcker was crushing inflation with 20% interest rates. The economy entered a brutal recession. Today, rates are at 4.5%. The Fed is engineering a soft landing. The macro environment isn't nearly as hostile. More importantly, 1980 didn't have an industrial revolution built on silver. Solar, EVs, electronics weren't consuming 430 million ounces a year in structural deficits. The world needs silver for the energy transition. That demand floor didn't exist in 1980. Let me show you what this means for your money. If you're holding a traditional portfolio, you lost about 1% on Friday as stocks dropped and metals crashed. On $500,000, that's $5,000 gone. If rates rise another 50 basis points under Warsh, stocks could drop another 3 to 5%. Bonds lose 1 to 2%. Your portfolio drops from $500,000 to $470,000. That's $30,000 erased. The contrast. Those who bought physical silver at $45 in November, even after this crash, silver at $80 is still up 78%. Gold buyers at $3,800 are still up 23% from $46.89. China bought gold every month at $3,500, $3,800, $4,000. They're still winning after a crash from $5,100. Here's why this matters now. The window just opened. Not because I know 80 is the bottom. We might go to 70 first. Gold could test 40,000. The window matters because of structure. Every solar panel removes silver permanently for 30 years. Every EV consumes an ounce for 10 to 15 years. That metal isn't coming back to the market. I've tracked this market since 2011. I've never seen a structural deficit this large while prices crashed this hard. Look, the question isn't whether we see more volatility. The pattern shows the path. More swings are coming. The real question is, are you positioned for what comes next? In every previous regime change, 1980, 2008, 2011, tangible wealth preserved value while paper promises eroded. Right now, silver sits at 80.71, gold at 46.89. The next week determines whether this was capitulation or the start of something deeper. I share real-time updates and deeper analysis on social media. For those wanting members-only analysis and early warnings, there's a premium level. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations. But the fundamentals speak for themselves. And if JP Morgan's right about 6,300 gold by December, buying at 46.89 might look like the opportunity of the year. All right, before you go, 3 quick things. 1. Drop a comment below. Tell me where you're watching from. And give me your prediction. Where do you think silver is headed by end of February? 70? 90? Back to 100? 2. If you're not subscribed, hit that button now. I'm putting out unfiltered analysis 3 times a week. And listen, I'm fighting copycat channels stealing this content. If this video provided value, comment real analysis so the algorithm knows you're here for the original. 3. Next video drops Wednesday morning. I'm covering the one indicator that predicted 2008. It's flashing again. Last time this triggered, gold dropped 30%, then doubled within 18 months. You won't want to miss it. See you there.